Good afternoon, ladies and gentlemen. Welcome to Cordros Economic Outlook. We just give a few minutes for the others to join. Thank you for coming online on time. So just give a few minutes. You're welcome. It promises to be an exciting session. We have Mr. Bismarck Rewane already on the call, and of course Jolomi Odonghanro as well is on the call. Okay, welcome again. My name is Jolomi Odonghanro. I'm the Managing Director for Cordros Asset Management. Cordros Asset Management is a subsidiary of Cordros Group, and this webinar is being brought to you by Cordros. Cordros is a financial conglomerate. We have 6 businesses: asset management, investment banking, securities, registrar, and trustee. And today we want to look at the macro environment. We believe a lot of our clients and would-be clients are usually asking, what's the direction for the year? And we believe that economic outlook plays a crucial role in investment decisions, providing insights into overall health of the economy. We believe by clients analyzing some of these indicators, it helps them make informed investment decisions. It helps them allocate their assets, investment appropriately, and of course to generate good return or generate alpha. Before we start, just to mention some housekeeping rules. This session will last for about 2 hours. We're going to have the macro session first, then financial markets. Then we're going to take Q&A. I believe we have questions and answers that we want to ask. Oftentimes people want to ask about exchange rate, the economy, GDP, and I believe we're going to have time to look at those questions. Some other rules, please let's stay muted. And if you have any question, please drop in the chat box, and we're going to have enough time to take questions and answers. So I have on the call, I'm going to introduce my guests. So I have Mr. Bismarck Rewane. I'll say it doesn't need so much introduction. Everybody knows him in the market. And I'm going to read his bio. So Mr. Bismarck Rewane is the Managing Director, CEO of Financial Derivatives Company.
I think you can skip that because everybody knows that, so we can make progress, right? Okay.
Okay, great.
Yes.
So we all know Mr. Bismarck, over 40 years experience as an economist and as a banker. We also have Jolomi, who is the head of research and strategy at Cordros Asset Management, also extensive experience, and he's done research across multiple organizations. So I'll skip the bio and go right into our presentation. The first presentation is going to be taken by Mr. Bismarck Rewane, and he's going to speak about the macro environment, global macro, local macro, and just looking at some key indices. So please, let's make Mr. Bismarck feel welcome. I'm going to put on my slides, and Mr. Bismarck, you can go ahead and share your slides. So over to you, sir. You can go ahead with your presentation.
We're trying to share the slides, so I'll talk about it. Okay. Slideshow. Okay, do you see the slides now? Do you see it?
Oh, yes.
Okay.
You can see the slide here.
All right, so let's go to the meat of the matter. Good afternoon, ladies and gentlemen. It's a pleasure and a great opportunity to be speaking to this august audience of investors, wealth managers, and I don't want to use the word speculators, but investors, wealth managers, and asset managers, and corporate bodies and institutions. So today we're going to be talking about what we think the Nigerian economy will be looking like in 2026. We're going to follow up with the sectors that are of great interest and things that will change. And thirdly, we'll go into the global environment and trends in 2026. What is trends in 2026? And then we will conclude But let me start off by saying that 2026, let me go to the next slide. It is a 2026 is a year, so it's a year of, I would say, three parts or two parts, depending on how we want to look at it. The first part of the year, which is now, is first in January and February, is a year to make resolutions and break the resolutions. But again, there were forecasts that were made last year and forecasts, and how did the year happen? We had government forecasts, we had IMF forecasts, we had World Bank forecasts, we had our own forecasts, we had EIU forecasts. And what happened? The forecasts were narrow, in terms of there were no big wild swings. There were expectations when Donald Trump went into the office on January 20th and the day of liberation thereafter. We saw all of that. And so we would kind of go back to the Nigerian economy in 2026. But we do know that this is a year in which there'll be elections, both in America and elections in Nigeria. Some off-cycle elections, but also everything to do with the politics of 2027 will be known this year. So in 2026, some things are going to be driving it. In general, new tax laws, weaker US dollar, and we'll come back to that. Gradual but maybe aggressive easing of the monetary policy rate. The budget we're going to have in this month, that is this week and next week, we're going to have the budget of 2025 concluded. The budget of 2026 has been presented, and so you would have that overlap between the end of 2024 budget, which was supplementary, 2025 budget, which was, and then the 2026 budget, all triangulating into one budget process. We are going to have oil prices volatile, but that's natural. But generally, we see oil prices trending downwards. We are hoping that we'll have the Dangote refinery listed, and that will have the capacity of almost doubling the market capitalization of the stock exchange. We're going to see an increase in the fiscal deficit in nominal terms, and also, to a large extent, in real terms, both directionally and nominally. We are going to see an exchange rate that clearly is within an aligned exchange rate, but pressures on it, which means the exchange rate may weaken at some time. But when I say weaken, nothing compared to the past, but just a natural rate of exchange rate depreciation that is consistent with the rest of the world. We think that PMS price will fall initially and at the end of the price war to stabilize and start coming up gradually. The government is going to be spending, because of political exigencies, they're going to be spending a lot of money on income distribution, poverty, I would have said, social interventions, and so on. Where do we start here? We start here simply by saying that in 2026, the forecast, the real GDP growth, according to the World Bank, so according to the IMF, is 4.4, but generally speaking, we're talking about almost 4%. And what national savings, and I'll come back to each of these parameters, what the importance of them. National savings rate of about, that is assuming that the nation earned 100 billion, we think 26% of it to be in savings. Savings is considered of compulsory savings, which is pension, non-discretionary savings, and then national savings, and that includes stock market capitalization. If, for example, you were to have a stock market capitalization of 100 trillion naira increase, it means 100 trillion naira will come from consumption or government and will go into the stock market. And say, let's say we gave that to Dangote to expand its refinery, that would be the effect of that. So interest rates here, there's no one interest rate, but that is the policy rate. The general level of interest rates will be that you have lending rates, savings interest rates, and all of that. So this is the policy rate. And then there will also be the treasury bill rate, there'll be bond rate. So we're taking one, and the policy rate is going to be a guide. And then please ignore that PPP dollar amount of $9,510. Inflation, end of period inflation. The target for the central bank is 18.5. So we'll leave it at about 18.5. Non-food inflation, it's going to be maybe non-food inflation is 18%, but these are just projections. Now, gross external reserves, there are some people who think that it will go up to $50 billion, but the conservative approach is $44 billion. Capital formation as a percentage of GDP will be 21.22%. Exchange rate, we're given a range of 1,500 to 1,600 here. Fiscal deficit as a percentage of GDP, we're talking about minus 4.1. Remember that the safe rate is about 3%. And that if certain steps were not taken, this could have gone up to 8 or 9% in reality. Fiscal deficit in nominal terms, almost 20 trillion, but maybe 20 trillion. And this is federal government deficit. Please do not mistake this figure as the total fiscal deficit in a nation, because there are 36 states which are all running deficits. So in reality, you could have a deficit could be as much as almost 30 or something trillion naira, right? Petrol price per liter, end of year is about 739, but it will go lower before coming up. So, and I said I'll come back to the GDP growth rate and national savings rate. Basically, I think I've touched it more or less. Let's go. So the approach to look at this, because here on this call, we have almost 300 participants already. People have to look at the global economy itself. That when I say the global economy, that is the Nigerian economy in totality in aggregate form, and then break it down into various sectors, and then break it down into how it affects you and your industry. I think that is very, very important that we know that. So there are certain things that are important that you know as investors, because everybody here is the reason why you are joining this call, you want to know, one, where to put your money, how best to maximize your wealth, and how to sustain that wealth as you go along. So we're understanding that there's real GDP, which captures the growth, real GDP growth of the economy when you now take it in the context of total output of goods and services, and made up there are loads and loads, hundreds of activities, but the key ones are about 40 something activities that are tracked by the NBS. Then we also look at what we call the real GDP and the potential GDP. Potential GDP means that if, for example, let us say the price of oil increased, doubled to $120 a barrel. The oil in the ground, right, is potential GDP. It's when you bring it out that it becomes, right? There are many things that, because, let us say the grid can produce 20,000 megawatts, but the transmission constraints makes us only to have about 5 megawatts. The potential GDP is that if those 20,000 megawatts are produced, what will happen? So potential GDP, if you notice here, is growing, but for the first time in some years, potential GDP was always higher than real GDP. For the first time in some years now, we are going to be seeing real GDP increase higher than that of potential GDP, but that's an academic exercise. Two other things that we have to look at is labor productivity growth and total factor productivity. I try to look at them in isolation, because labor productivity growth is based on skills and technology, while total factor productivity is another thing altogether. That's optimal use of capital stock. Okay, so if we must take them in isolation, the total labor productivity means that people are producing, skills are there, their health is stronger, that they're not. For example, if there was a malaria scourge or cholera scourge all over Nigeria, the same people, the same skill, but because they are all ill, they'll produce less. So you want to look at it in that context. But if you look at labor productivity growth has gone sharply higher. It was 0.4. It went down during 2022 to minus 1.7 to minus 2.6 and has started growing in 2024, 2025, and has started dropping again. Well, the drops coincide at times with outside problems and also with recessions. Now, another thing, Purchasing Managers Index is telling us that it's showing us signs that we will be expanding mainly in 2026, but the rate of expansion of the PMI in 2026 will not be as rapid as you saw between 2024 and 2025. Anything above 50 is expansion. So in 2024, it was 50. 2025, it got to 54. And that's significant. That's at least 8%. Now we are looking at 2026 at 55. So it's expanding, but it's not contracting. The monetary aggregates, a couple of things we look at when you look at monetary aggregates. You look at inflation, you look at money supply growth, you look at transmission effect and high-powered money. All of this point to the fact that the central bank as a policymaker is going to be very circumspect. They will loosen a bit. Their stance is not going to be negative. Their stance is going to be more of neutral to expansion. So you look at the inflation rates, and they've done some really interesting financial engineering here. So we expect that based on the old methodology and new methodology, generally speaking, interest rates, inflation target for the year has gone from 6 to 9 to 18.5. So that way, we've talked about a few minutes ago. We talked about the growth parameters, and growth in that case, growth in 2026 is going to be driven by increased oil output, right? It's going to be driven by downstream sector investment. It's going to be driven to a large extent by also some upstream deep offshore exploration. And it's also going to be driven by tapping in and sweating assets by the fast-moving consumer goods, and also going to be affected to a large extent by power. So now we are talking about monetary. There's money supply, there's exchange rate stability, there's inflation, and there's also interest rates that will be used to drive this process. Now, the exchange rate is very, very important, and it's important to look at it from two perspectives. One is what is fundamental, and then the other one is to look at the technical issues. So this is just telling you that if you do the PPP analysis, the Naira should be trading at 1,256, which means compared to the official rate, it's 11% or 12% undervalued. It used to be about 21, 22%, right? Now, so we expect the Naira to, against the dollar, not that bad, but against other currencies, the Naira would weaken it somewhat. What are the fundamental things that drive exchange rate determination? We have oil revenue, which is number one, oil and gas, our total export earnings. We have current account balance. We are expecting that to reduce from 5.8 to 3. We have remittances from diaspora and creative art and creative industry. We expect that to increase, but we have to caveat that because if AI is displacing people and some of our Nigerians, of international remittances would drop, because if they get fired, then they will not have money to transfer. And the whole ICE, that's immigration and customs people, are also driving down pressure. The immigration is a major issue in the world. Trade balance is going to be down from, okay, the trade balance is usually in dollars, so I will leave that now. Now, oil production, we expect it to come down a little bit, but well, let's be careful there because they might see an increase in oil production. Gross external reserves are up from 45 to about $47 billion. And oil price for the year 2026, we expect it to actually go down to about $58 a barrel. So we'll change the slide as we send it to you guys. Now, a couple of things that we need to do is that I've shown you what the PPP is, which is 1256. I've shown you the fundamentals that 4 of these items here, that's 7 items, of which 2 are improving, and 5 of them are actually deteriorating marginally. So just an academic exercise, just for your thinking, if you take the total money supply in Nigeria, cash, and ask us to take our total reserves, and in other words, if the external reserves are shared amongst the Nigerians, and for every we give up, we are going to seize all your accounts, freeze all your naira in your account, and for every, we are going to divide all the dollars we have in our reserves, so the naira will no longer be a currency. All you have is the dollars, right? Today, the total amount of all our money put together in the bank is 123 million naira, 123 trillion naira. And all that we have in the reserves is $46 billion. Okay, so when we withdraw your naira and give you dollars, all of you will get 2,000 for every you get $2,631 naira per dollar. That's a very crude way of saying exchange your naira for dollars, right? So how much, if you had 1 billion naira, you'll get so much, right? The other way is look total money supply compared to your total exports, right? So I'm saying this is your money supply, all the exports, oil, gas, cocoa, everything, right? All the exports we are going to give dollars to everybody in Nigeria. You have 2,858 naira per dollar. So you can see, don't forget we started off with 1,265, which is the PPP. Then we went 1,256. So there's also the simplistic way of using what we call the hamburger index. You take the price of a hamburger in New York, divide by the price of a hamburger in Lagos, Burger King, 18,000 divided by 6 or something will give you 2,690. And then PPP 1256. So look at all these exchange rates and see that best case scenario, PPP 1,256. Worst case scenario, adjusted money supply, 2,800. But there's some similarity. So look at it. So these figures mean that monetary economics works. If we had one at 50,000, the other one, so they're within a range, which means that it makes sense, right? So what the central bank used to do in those days, they used the crude one, which is money supply divided by exports, right? But even go further, they add money supply, no exports to reserves. Exports are things that have not been sold. Reserves are what is already there. When they add the two together, you end up with $90 billion. And if you do that, really, you get a figure almost equal to your PPP. Okay? So, quite frankly, there's a pattern to the madness here. Okay? Okay, so thank you very much. I've bored you enough with all those numbers, which may not make sense to you, but investors want to know, okay, after all this is done and done, where am I going to make money? Or where am I likely to lose money? That's why we're having this session today. And we already have 300 or so participants here. So what do we expect? Why do I say it's a year of 3 parts? Part 1 of the year is January, which is what we are in. We're all breaking our resolutions. All right. Part 1 of the year means that in January, people are broke. So people are spending less and expect prices to start coming down because they have less money. January typically in January, the exchange rate depreciates because people are going back to school, paying school fees. But this year is slightly different because to get an American visa, all the people that came from America all run back, right? To get an American visa, you need to put $15,000 bond. Which you have 30 million naira, which you put in your bank. Then you will buy your ticket. Then you will pay for the application. And there's no guarantee that you will get it. And if you get it and you travel, if you don't come, if you come back, they give you your $15,000. If you don't come back, you forfeit that. Nobody is going to go through that process. So we've seen a sharp decline. In December, visiting friends and family came, but not as much as they used to have. So part one, budget complete. Part two, oil price is declining. That's part one. All of this, number one, number two. Number three, central bank will meet next month and do something about interest rates. There'll be some cuts. Number four is that the Federal Reserve Bank Open Market Committee will meet next week and will take a decision. I do not think that they will cut rates. Although GDP growth yesterday in the US was 4.4, that's the highest it has been for some time. Inflation is still, the inflation target for the Federal Reserve is 2%, and inflation is still at about 2.7, 2.8%. So, but let us assume that the Federal Reserve does not cut rates. Let us assume that we use this new inflation number. We think that the Central Bank of Nigeria, what best case scenario, will cut interest rates by 100 basis points. Every 100 basis point cut in the policy rate will translate into almost a 1 or 2%, 1.5 or 1% cut in market rates. Because last time when they did that, they also changed our symmetric corridor. So we are going to have that situation is going to continue. Now, so there's no point trying to catch a falling knife. The reality is that we think that the probability that they will cut and status quo is 35%, that there'll be an increase is almost a 0% probability. Fiscal, how is the government going to spend? Fiscal also has the budget. We're not talking about budget. We think that this year the budget is going to increase in nominal terms by about how many trillion naira, but in dollar terms, right, it's not going to increase that much. We think that the parameters, the deficit and others will increase, but also some borrowing will increase. So of the four parameters they use in 2025, growth, oil price, oil production, and inflation, everything was negative, but the exchange rate was positive. The target was that the naira would trade at 1,500 naira at the end of the year. It actually traded at about 1,435 officially. Not in the parallel market, about 1,490 at the end of the year. Okay, so 5 parameters, 1 green, 4 red. Now we're looking at, see, the deficit of today is the debt of tomorrow. And the debt of the thing about debt are liabilities, and your assets, your global reserves are part of your assets. But let me make it clear that the external reserves of a country is not government money. We have that. I want everybody to understand that. Your external reserves is the total value of dollars owned by Nigerians, both private and public, kept by the central bank. Okay? So if MTN wants to transfer money, the reserves include MTN's money that is sitting there, Mr. Rewane's money that is sitting there. And if Mr. Rewane wants his money, wants his dollars, he doesn't need anything, he just goes and grabs it. So the reserves are not, it's not government reserves. They are reserves of the economy. 1. 2, but the reserves are there for everybody. So not everybody will take their money at the same time. For example, if Farmer want to keep our money because he doesn't want to use it until maybe later in the year. Mr. Rewane wants to take his money because he wants to use it this month. The central bank doesn't want to know whether whether a farmer wants our money, they have the reserves there. If farmer wants our money, take. Mr. Rewane, you want your money, take at any time. And that's why you have external reserves. I wanted to clear. In that external reserves, the excess crude account, they say, oh, excess crude account has all of that. Excess crude account is kept in Naira, but it's the dollar reflection of it that you have. Now, if you look at our total debt in Naira terms, in dollar terms, in 2021, and this is contractual and non-contractual debt put together, total debt was $95 billion. In 2022, it had gone up marginally to 103. Don't forget this was COVID was just post-COVID. We saw our public debt, our reserves dropped to 32, and our debt increased. Then in 2024, there was a new, all the, what do you call it, economic reform. Our debt actually came down to $94 billion, while our reserves increased. Because the exchange rate had been depreciated, the incentive to go and take money out of the country dropped. And so that's the first sign to show that market policies work, right? So then by 2025, we had to make some payment. Then we paid all these forward contracts, right? Our reserves then went up after paying and all of that and earning some money and borrowing some money, additional money, right? Our reserves went up to $41 billion, while our debt stood at 94. Then come 2025, later on, our debt increased by almost $17 billion, while our reserves increased by only $5 billion. As of today, our debt, both contractual and non-contractual, is $126 billion, and our reserves are $44 billion. So, but it's a better picture, right, than what it would have been if. Now, what will all of it look like? So this chart here tells you that 2025 was not a bad year, but 2026 is going to be a tough year because we expect some openness, open, more of an open economy, more imports in some cases, more exports because the oil companies are now trying to invest. But many of these investments will not take place until after August 2027. Because nobody throws money into a developing country that is going to an election. So the economy is going to be maintaining its growth momentum, but cautiously. Investors are going to be sleeping with one eye closed. So what are the sectors that we are looking at? And earnings are being used interchangeably with revenues, while some people think earnings are income. So projected revenue in telco sector is about 41 trillion when you put all the things together, right? So, and that's a lot. But the economy, Nigerian economic GDP is about 350 trillion in Naira, about 350 trillion Naira. So if the revenues of telco sector alone is 41 trillion, it tells you that it's almost 11 or 12% of GDP, right? Why is the telco sector interesting? Telco sector has suffered severely. There are no price increases, they were constrained all along. So now they're allowed to do this. Now they're investing in broadband. Now they're investing in AI and streaming. So 41 trillion Naira, the total revenues from that sector. And you have both GSM operators, what do you call these other guys? The guys who fixed operators. There's going to be more base stations, more 5G in certain areas. Right now, 5G is less than 10% of coverage in Nigeria. So let's say that. So you still have 2G where you just use voice or 1G send text, right? Then 2G, 3G, 4G, 5G. You're going to have 5G more in Lagos, in Abuja, in Kano, in certain places, right? So we see that technology and fintech, which are tied to telecoms, are also projected to get about 3 trillion naira. But these two sectors' growth depends on something else, the power sector. So this, if I, as an investor, the root cause of weaknesses in this other telecoms and ICT and fintech is power. Almost all the devices you have today are so power intensive in their consumption. So if you have a iPhone 17 or the new Galaxy, or before you stream one thing or use one of those AI things, you're going to. So it means that in 2026, whether we like it or not, the power sector is going to have to face some major reform, both institutional and in terms of logistics. So no, nothing off guard, offline. And we think that they probably open up the transmission side. The Gencos, there's some forbearance taking place, and the discos are going through some major constraints. The discos, the grid is down most of the time, but we are also seeing that the discos are facing some structural competition from the solar renewable energy, and it's become clear that renewable energy costs is lower now. If you discount the capital cost of the upfront, it's much lower than fossil fuel, thermal, and all that. And so we've seen that. So I would say that take note of this. Telco and ICT, very important growth sector. Fintechs, which is a spin-off of the financial services area, is very interesting. But tied to this is power supply. Now, agro processing, again, there's going to be a lot of growth here, but some sectors here are threatened. Those in pure commodity play will be threatened, but those in fertilizers, those in genetically modified seedlings, those in aquaculture, horticulture, and animal husbandry are going to see growth here. Sales growth. All right. So agro processing, agro storage, and distribution, and things to protect you from what we call want to protect you from storage, post-harvest losses. Manufacturing, let's break it down. When we say manufacturing, we're talking about light manufacturing main, and so I would like us to say that building materials, right? Cement, aluminum, and all those, good. We think that light, fast-moving consumer goods, dairy, cocoa drinks, and all that, so you're going to have a lot. Before I forget, the agri processing, we like corn oil and others, but we'll come back to the specific, but these are just sector level. And at manufacturing, once we get manufacturing under optimal and competitive, we will begin to ship a lot of our goods into the western part of Africa. So new opportunities in fintech, technology, and power are what we have to think about. And I think it's important that we know that. So renewable energy, oil and gas, AI are the new, but no, we don't expect major investments in this area until after the elections in 2027, which is the election next year, in 12 months' time. Are there threats and challenges? Yes, insecurity and infrastructure without problems. In Benin Republic, there's an election coming, and everything points to the fact that the incumbent nominee will win. But also, there are some major issues in Benin Republic about ISWAP and others. So, spillover of things in our neighboring, and also We have Cameroon next to us, which also has some the president has won in another term, but he's old and frail and anything possible. So insecurity and infrastructure gap is one. Global commodity prices, there could be an upside shock whereby Zelensky and others come to some terms and the price of oil comes down further. That's a shock. But it also means that the wheat, sugar, and other prices of import commodities will come down. Third point is fiscal pressure and high public debt. We have elections coming. You cannot stop a politician from spending during an election and run up to election. There's nothing you can do. I don't care what party is there. There's going to be spending, a lot of spending. One, in projects. Two, in campaigning against and then three, finally to probably buy your PVCs and all of that. Could there be disruption and instability? That's a risk that it's remote, but never say never. Market outlook. So these are proxies that you think about. We are seeing our rig count come down slightly. We are seeing the ships awaiting berth come down slightly because even though imports are increasing and exports are increasing, the efficiency of getting them out and in means that bigger vessels. Stock market capitalization, I always take this with a caveat. Stock market capitalization is going to go up by almost 100% from 100 to 200, depending on the listing of Dangote Refinery, listing of NNPC maybe, listing some measures on acquisition due to recapitalization of banks, insurance companies, and so on. The corporate profits of the top 5 companies will go up from 2.7 trillion to as much as 6.2 trillion. And that is significant. That's more than 100 and something percent. Pension assets will increase from 27 to about 36 million, by 9.4 trillion. That's quite interesting. So one thing that is clear is that Nigeria will be integrated mainly with the global economy, and there are different views. Goldman Sachs expects S&P to reach 7,600 by the end, which is 11% higher. So let's take, if I had a US asset, US inflation is 2.6%, and I get 11% return on my equity portfolio. I'm really three times better off, right, compared to inflation. If inflation is 2.6 and I get a return of 11, 2.6 times 3, in fact, you need 2.6 times 4 to get there. So this will be a good year for US equities. If the projection from Goldman Sachs is right, that the price of gold will go as high as $6,000 pounds. So if I said, look, I'm not interested in your equities, just give me my money and buy gold, I could get as much as it's today 4,800. So you get a 25% return, more or less, on gold. The world's most valuable companies are above with over $3 trillion, NVIDIA, Apple, Alphabet, Microsoft, and so on. I'm surprised that, Google is not, Alphabet is Google, sorry. So the Magnificent Seven become the Malevolent Seven, right? They grow their earnings by over $701 billion, but their cash position is going to be much more than $80 billion. Okay. Bitcoin continue to swing. So you as a Nigerian say, okay, well, I don't want to pay taxes. The new tax laws are too aggressive. Just give me my money, I take it out. If I keep my money in the bank and everybody can see it, it's a problem. So I don't want that. Just give me my money, I'm going to put it in Bitcoin. It's possible that you buy Bitcoin at 135 and then all of a sudden it drops to 20,000. So I don't know. But some of those cryptocurrencies are called stable coins. They are the furthest thing from being stable. So if anybody gives you a name, names his asset stable coin, you should know that there's a reason why I said that, because he knows that it's not going to be stable. In Nigeria, we expect some new listings, not that many. There are 180 companies listed, but maybe 5. We do not expect delisting. Market cap is expected to go from about 105 now, maybe at the end of the year, 200 if Dangote lists. Top 10 companies' earnings will reach 8 trillion from 4.7, so 100% increase in their earnings. But this is where it's disturbing the price earning ratio on the exchange as a whole, about 45.7, which means that if you invest money now, it will take you 45 years to get all your money back based on the earnings. Okay, so if you are 30 years old, and invest your money, you have to add 45, you'll be 75 when you get your money back. So that's not, but again, those earnings continue to increase, therefore the number of years will go up. So daily turnover is 135 billion. Okay. All right. So financial recapitalization, impact of that on capital markets. So balance sheets will get stronger. People will use capital, but at times there's something called too much capital. When capital, capital depends on value creation, not value destruction. So we don't know, but policymakers and regulators have a mindset that the reason why these companies are doing badly or companies are doing badly is because they are not well capitalized. We've changed that completely. So there'll be improved risk management and there'll be some financing, but the money that people are taking from banks will reduce while the money they raise from the capital markets and debt markets will increase. So policy reforms in 2026, new tax law, it's a big one, bank recapitalization, insurance company recapitalization, VAT on service charges, and institutional reform in terms of people that will. Now, let's look at all the investors, the Cordros Capital investors are sophisticated and affluent. They live in urban areas, both here, and they are global citizens. Their children are in schools in all over the world. Now, what are the expectations of 2026 from the experts? The economist said the following: rigid blocks to fluid alliances, that all those NATO and others, and people forget that. And we saw that yesterday when Trump announced that he was setting up a new organization to compete with, more or less, with the United Nations, withdrew from the World Health Organization. All the European companies, including the UK, refused to join. And that's the first signal. Because for two things: one, they don't think that's two. He said that Donald J. Trump, continues to be the president of that organization even after he leaves office. So people say, "Wait a minute, what are you smoking?" Right? So that's what happened. So we see these alliances, the AI investment, very important AI investment, and AI investment is extremely power dependent, very power consuming, and like Farid Zakaria said last week, that one question on AI is equivalent of using your microwave for 3.5 minutes. So because I say AI, please tell me what the Nigerian budget is likely to be in the next 5 years. It will come up with an answer, but to get that answer, it has to go through so many parameters, right? So power is going to be a major impediment. United States will mark its 250th anniversary, and they'll be going back to the basics. Adam Smith is going to be having his 250th anniversary when he wrote The Wealth of Nations. So the world, like I said at the beginning here, the world shifts from rigid blocks to fluid alliances, so that has been repeated. Yeah. So despite domestic issues like deflation in China, we think that there will be new alliances, and that China, Russia, Brazil, and that the one other thing that I have to let everybody know, that some people have shifted, countries have shifted many of them have shifted very small part of their reserves from US dollars Many of them have gone to Australian dollars, gone to Chinese yuan, some to gold, and other precious metals. The Financial Times subsequently has come up that says that AI bubble will inflate US liquidity. High living costs will push US inflation higher, with food prices up by 30% in 5 years, which is 5% a year. Quality stocks will regain favor after a poor 2025, and immigration collapses across advanced economies with inflows down 85%. Right. Chinese export dumping will intensify. They will dump mainly solar panels. Also, the Chinese will invest a lot of construction projects in Africa. Global equities will gain ground as a weaker dollar and cheaper valuations attract investors outside the US. So that's the global environment. I want us all listening here to understand that Nigeria is integrated in the spillover effect, both positive and negative, on Nigerian economy and Nigerian markets. So investors, you've got to look at what the options are. So global GDP to remain resilient. So even though Nigeria is growing at 4.4%, outperforming the global rate, outperforming the African rate, which means the Nigerian economy is beginning to look fundamentally attractive from an investor perspective. So, but the investments will not take place until after the elections, right? And we'll see how that goes. But there's also a midterm election in the US, and there are some local government elections happening in the UK, and we are seeing the emergence of the Reform Party. So is the world going to be swinging on one hand from conservative thinking to liberal left-wing thinking, or is the world going to be moving in the other direction, more to MAGA, make America great again and all that stuff, right? So if you look at this, you see the advanced economies are growing at about 1.6, emerging economies are growing at about 4%, and sub-Saharan Africa is growing at about 4.4. It tells you the story. But growth doesn't tell you everything. It is actual contribution, because law of small size is the smaller you are, the faster you can grow because you are light. Okay. There are risks, cause crisis in Middle East, crisis in Iran. Donald Trump dropped bombs in Iran because we did that in 1979. We saw what happened, and anything is possible now. Global inflation to decelerate. We think that's going to happen because once the supply shock, the supply chain disruption stops because of Ukraine. I just want you, let's close our eyes and imagine that Ukraine has a ceasefire. All of a sudden, oil, steel, wheat, everything. And so could that mean that output increases and prices drop, and then we'll have a great year? So, but global interest rates are set to decline, but I think that we've been seeing some spikes in inflation which were unexpected. And one of the underlying drivers, which the World Bank and the IMF will talk about, is the impact of increased investment in AI on output. We are now seeing driverless cars. We're seeing all sorts of things, right? So robots are being called, people are having robots rather than having house helps. You tell the robot, go and dress my bed, and it goes, the robot, go and bring my orange juice from the fridge. It goes in, opens the fridge, brings that. So I want you to imagine that right now, a lot of people have house helps and all that. With robots, who knows? Those house helps will now be part of the unemployed force. And then they begin to mug people and all of that. So you can't get a robot to mug, but you just. So there's a need to do something, invest in infrastructure. So let's take a look at some of the countries. We have the targeted inflation, we have the current inflation. Ghana is interesting to us because we have a lot of Nigerian banks in Ghana and a lot of Nigerian exposure there. Targeted inflation is 3.7. Current inflation is 5.4. But let us sit back. 3 years ago, 2.5 years ago, Ghanaian inflation was as high as 55%. Now it's down to 5%. Can you imagine from 55% all the way to 5% in a matter of 3 years. And when you look at the currency against that, currency went from around 14, 15 cedis to about 11 cedis to $1. Well, what? Now, Bank of England current inflation rate is 3.2. Target inflation is 2%. But don't forget that 3-4 years ago, when Biden was in office, inflation in the US got up as high as 9%. In the UK, about 12%. Now, things have been brought down. Bank of Canada, very interesting, inflation 2.4, and actual inflation. So look at Canada and look at the United States. The targets are the same. While current inflation in Canada is 2.4, current inflation in the US is 2.7. Something is going on there, right? And Canada is trying to explore other alliances. Interest rate gap between inflation and current rates, tells you something. In Nigeria, we have targeted inflation is now, no, inflation target has been changed to
14.5 to
14.5, right? But so definitely. So again, that will be a major determinant of your investor appetite and your risk appetite for investors. So major variable that will determine Nigeria's output, inflation, deficit, and exchange rate is the price of oil. So it's interesting to see 2026 outlook. EIA says $56 a barrel, and Brent $54 a barrel for this Brent in 2027. Our budget is based on 64, it was based on 75 before. So with this, if this happens, $10 a barrel is our negative headroom. Goldman Sachs even saying that Brent will be 56, but it expects a recovery in 2027, right? Because it thinks there will be growth and all that. JP Morgan is very, very bearish. Says $58 a barrel in 2026 and $30 a barrel. If it goes to $30 a barrel, we might as well close shop and everybody go home, right? Reuters poll says that $62. So the picture is that it's going to be a very tough year for us. Very tough year. Now, next, global investment environment. So we've talked about that already, tariffs, counter tariffs, and so let's not waste too much time on that. We've already passed this. Now, portfolio mix for a lot of these investors on this call. Gold is important, but gold is the natural safe haven, right? It does nothing. Gold is used for nothing. It's just a fear of safety, right? So how is gold? Gold is produced in a mine in South Africa. Mine taken up and then shipped and kept as gold reserves in another hole in America in Fort Knox. Does nothing. Then okay, some ladies use it for jewelry, but if I look around, I don't see too many ladies wearing gold these days. But because there are other substitutes of precious metals, but the Ghanaian economy I was just talking about relies a lot on gold. So gold is a good asset to have, but don't overweight it too much. Safe haven status. But if there's a conflagration, if there's a war, the day that 9/11 happened, the price of gold doubled within an hour. Everybody, once there's a fear of any crisis, you'll buy gold. Equities, Goldman said 11% against inflation of 2%, I think, or 2.7%. US equities have a lot to go, but what equities? Is it NVIDIA? Is it Apple, Google, or is it General Electric? So we have to, your advisors will advise you on that, but we like US equities. But come to face it, come think about it. The US economy, almost $27 trillion the $105 trillion economy. And 25% of global output, they have less than 1.8 or 2% of global population. The state of California is the 7th largest economy in the world. So we like US equities, but spread across sectors. Capital preservation, treasury bills in Nigeria, well, not the most efficient thing to do, but it helps. Real estate is looking good, but real estate will suffer once the election process starts next month in February. People start selling houses to buy delegates, right? And then sell houses to buy PVCs later on. Okay. So in conclusion, real GDP is anticipated to expand in Nigeria by 4.4%, globally, by much lower, about 3.5%. In Africa, about that. Inflation globally is about to decline. The Chinese economy is going to grow. Our trade partners are going to change, and also our trade patterns as well in Nigeria. We're going to be dealing with countries that have weaker currencies, so that we can, reap some benefits there. The US dollar is going to weaken, and which is deliberate. It's part of the Mar-a-Lago Accord. They will use that as, you see, it's the three places they compete globally is with currencies between the Chinese and the Americans, intellectual property theft, which is, so you have TikTok versus, what do you call this other one? Not Facebook, TikTok versus Instagram, right? No, YouTube, I think. Facebook versus TikTok versus YouTube, right? So you have the war of chips, the war of intellectual property, and finally the war of currencies, right? So the Chinese empire has been around for a long time, and they're not going to give up. They constantly. So the day you had in NVIDIA, they came up with what's the other DeepSeek, right? So they're ready. So this year, we're gonna. You've heard that Trump has not made any negative remark about China. So Chinese economy remains very strong and robust, but they're having some population issues now. Their population is declining, so they need to get things up again. And they're having longevity problems. 40% of the population above the age of 60 compared to 3% of population in Nigeria. 3% of Nigeria population above 60. So it shows you life expectancy. Monetary policy in Nigeria is expected to be mixed. That is, some people cautious, but we can expect money policy rate to drop. And if the money policy rate drops, so also with an increase in equity values, stock market. So listing, interest rate effect, and also foreign portfolio investors who put money in and take them out. So a policy rate cut, my colleague says 100 basis points, but now we probably know better. It won't be 600 basis points as expected by the EIU, but we may have 100, and then towards the end, technically you don't increase interest rates when elections are around the corner, except you have something else in mind. New tax law, again, it's everybody's bet. 1 is the law, 2 is the gazette, 3 is the implementation and enforcement. So those are the things that we are going to drive investor thought process during the year we are in. So ladies and gentlemen, thank you very much for this opportunity to share our views on the market as well. Thank you.
Thank you very much, Mr. Rewane. That was such an interesting session. Thank you so much to Chu. And I guess our audience already have a lot of questions. I like some of the things that you said, even though it's on the lighter note. You said people sell houses to buy delegates, sell houses to buy PVCs. And I guess that's sort of the reality we find in our climb. 2026 definitely will present headwinds, will present tailwinds. There'll be pains, definitely gains as well. And I like the fact that you're able to highlight key sectors that promises good return for investors. So please Ladies and gentlemen, please put in your questions in the Q&A box, and we'll be taking as many as possible. Also, like the part that you spoke about AI and some of the opportunities in that sector. I recently heard what Elon Musk said. He said we should forget medical school. That is sort of pointless. That by 2030, robots will replace humans and surgeons. But I guess that's left to find out. So very quickly, before we take the Q&A, so I just like Jolomi to sort of give you a view of the markets, fixed income and equity market, just very briefly. And we already have some questions, which we'll be taking. So Jolomi, if you may, you can just quickly just summarize your expectation for the fixed income and equity market in 2026.
Thank you very much, and good afternoon, everyone. So just to speak very briefly to our expectations for the fixed income and equities market, we've spoken here in session already regarding some of the variables that we expect to impact the markets in the coming year. The government has a significant borrowing profile for 2026, estimated around 20 trillion deficit, which will be financed both internally and externally. Internally, we expect about 14 trillion to be raised by the government in the year through NTB allotments and bond issuances. Now, that's a significant supply profile for the market, and all else being equal, would see yields stay elevated and even rising. But in our view, we have seen significantly more capacity within the market to absorb that supply following banking recapitalization and the upcoming insurance sector recapitalization, amongst other factors, that should see that supply being absorbed to a reasonable degree. So then monetary policy administration and how significant the rate cutting cycle ends up being should be a determining factor in how we see yields progress. As Mr. Rewane already stated in the presentation, we expect moderate adjustments to the MPR year and not expect the MPC to be overly aggressive. And as such, we're expecting only a moderate decline in yields in the fixed income market for the year relative to what we've seen in the past. But added to that, we also expect a normalization of the yield curve, bringing treasury bill yields below bond yields by the end of the period. And looking to the equities market, I mean, in our view, the equities market enters 2026 on a much firmer macroeconomic footing than we've seen in a long time. Disinflation is taking hold, currency stability has improved meaningfully, and monetary policy administration is expected to become progressively more accommodative. Now, these shifts taken together, we believe will reset to a certain degree the investment environment in favor of risk assets. Now, what that should mean is that the equities market should be supported by a favorable mix, including, like was also stated in the presentation, resilient and growing earnings, ultimately lower yields, compelling valuations, amongst other factors. Now, under these specific considerations, which I will term our base case considerations, we would expect the Nigerian equities market to return 36% for the year. Thank you, Bob.
Can I make a comment?
Yes, sir.
I'm not so sure. What I want to say is that the earnings, a couple of things, the share prices have gone up sharply in 2025 because earnings compared to 2024 actually increased. But 2024 earnings were based on the fact that 2023 exchange rate losses that actually impacted earnings. And so what the companies do all across all both domestic and international conglomerates and all that, they domesticated their international debt. They changed their debt due to suppliers, due to parent and all of that were all, so they took a hit on that. Now, in 2026, you'll be getting earnings for 2025. But 2025 earnings will be used to claw back some of the losses in their capital structure. So you will see that if you take sectors, let us say we take, for example, telecoms. Telecom sector is growing at about almost 9%. Telco sector is contributing about 12% to GDP. But MTN's revenues are up about almost 45%. So, but that is because their earnings it was in April last year that they were allowed to change the tariff. So if you look at each of these stocks, if you bought Okomo Oil 2 years ago, you would have made 150%. To think that it will continue at that rate is a bit too aggressive in terms of optimism. So you are going to have a normalization of returns. And the fact that all these companies all were coming from negative to positive earnings, how can they stay forward without investing remarkably, and how sensitive are these companies' earnings or this sector's earnings to exchange rate stability, interest rate stabilization, and normal inflation coefficients? So I'm being cautiously optimistic that the rates and the markets will perform well, but let us not get carried away, because when we compare 2025 performance to 2024, it looks great that it will continue on that same trajectory. I think that it will increase, one, and those companies that are doing well, the solid ones in Nigeria, will do better. But this is not a tide that will lift all boats. This is a tide that will lift the big and the best. And then as we go into 27, 28, we'll have a normal situation where competitive pressures will continue to play, and then we will have had an election in 2027. So I want you to put all of this together. Thank you.
Thank you, sir. So I'll just add a bit more context to what I was saying. So maybe that would align us more closely. You are right. There was significant growth in market EPS. As of 9 months, I believe that was around 49%, which is significant growth on a year-on-year basis. And we know the sectors that were supported by, like you mentioned, some of them importantly already. Our view is that while we will not see the significant growth that we have seen in the past, we expect the market performance to be more broad-based. And it's one of the key themes that we have for our outlook for the year. Added to that, we've seen dividend disbursements also improve during the year. It's an interesting dynamic there. We saw dividend disbursements increase while payouts did not significantly increase, which points towards an interesting dynamic. Companies were able to increase disbursements on a nominal basis to investors while also prioritizing balance sheet repair. So, that sets the tone for the coming year. You will see funding costs decline moderately, while at the same time balance sheets are much healthier, which will ultimately support a return to dividend disbursements and increase for dividend disbursements for others. Added to that, you have a return on equity for the market that settled around 24.3%, which is in 2025, which is the highest level since 2019, right? And when we look at that figure, the ROE will moderate because the equity bases have expanded quite significantly with the recapitalization we've seen, but profitability should remain structurally strong and reinforce the overall total return cycle. So when I look at the market, I'm looking at it from a very broad-based perspective, and I don't expect significant growth, but we expect the market structure to be stronger and the total return cycle to overall support the return I mentioned of 36%. Thank you.
Yep. Are there some questions from the floor, so we can?
Okay. Thank you, Jolomi, for your answers, and thank you, Mr. Rewane, for the additional comments. Thank you very much. I wanted to mention that Jolomi would have taken a presentation, but because we are trying to manage time, so that's why we went straight to the Q&A. But the presentation slides will be shared at the end of the webinar. Okay. So I have this question from Femi Akintola. And I think Mr. Rewane will be the best to answer. He said, based on what we believe to be sound economic management, we have kept the exchange rate under 1,500 to $1. You project it to stay around 1.5 to 1.6 in 2026. However, in your slide on the true value of the Naira, it appears that Naira may be currently overvalued and more likely should be above 2,000 to a dollar. What is the implication of this for holding naira denominated assets in the long term? What is the risk of this true value materialism over the next 3 to 5 years?
Okay, you misunderstood the slides. The slide said that there are about 4 different ways of computing exchange rates. It's like saying that you want to value a company, and no better persons to talk about corporate valuation more than Cordros Capital. You have the what they call price to book value, you have your discounted cash, you have your breakup basis, you have all sorts of things. But at the end of the day, the value of a company depends on its intrinsic value, its financial value, and basically what a buyer is willing to pay for it. So what we did there was say, look, the PPP value is at 1,265, and currencies move towards their PPP value over a 5-year period. Right? The PPP value of the pound to the dollar today is about 1.12, 1.12, while it's trading in the market at 1.34 because of the uncertainties around the Trump world. So we think that the worst case scenario is that the price of oil drops to $58 a barrel, right? Maybe 58, maybe 55. If that happens and Nigeria's revenues begin to fall, then the currency will come under pressure. Last year or the year before, the currency lost 75% of its value. We are saying because of oil, because of gas, because of efficient market hypothesis and investment values, we think that the worst that will happen is that the currency will lose 10%. And I said this at different fora. 10% of 1,500 is 150. It brings you to 1,650. If that happens, we were in 2024 November, the currency was October was 1,950 naira to a dollar. We had forward commitments, unpaid official obligations of about $7 billion. The reserves figure, nobody knew what it was. But ever since then, we've had audit statements, we've had financial reports that have come out to show that our net reserves are at maybe $22 billion. Gross reserves are higher. So we do not think, in a worst case scenario, I mean worst case scenario, the currency loses 10%, it goes from 1,500 to 1,650. Worst case, 1,650, 1,680. That is significantly better than what it was in November 2024. The heavens will not collapse, right? And from there, it begins to come back up. So it's not currency values are not linear. They don't just go in one direction. They change, and when things get better, they improve. So we're just putting that on the table so that people know that I have a few clients who converted their money, their naira at 1,800 to buy dollars to go and earn 1% or 2%. Some people left their money, right, and earned 14, 15%. And then sometime this year, they converted what they wanted at 1,480 or 1,500. The person who was in a stampede, who converted at 1,800, is looking at his dollars and it means nothing. So this means that you have to understand that market volatility is a natural phenomenon. Two, that don't try and catch a falling knife. The currency itself, these are guides, and that once the currency is fairly priced, it will not fall that sharply. What is it that people are using currency to do? They're using currency to buy inventory so that they can meet supplies. The average inventory levels in this country in 2023, 2024 was about 180 days. So people carried 6 months inventory because they didn't know when they would get forex and they didn't know when they would get supplies. Today, the average inventory levels are between 60 and 90 days. So the demand for forex has dropped because of that. 2 years ago, if you wanted money, you had to go and buy your PTA at the bank, do this. And if you're seen with a Malam, Boki FX, and all that kind of nonsense. We now have a situation where you can use your Naira cards again. So So the currency has been stable. We have clients who return our services to forecast the exchange rate for them. Over the past 2-3 years, we did that. Now all of them are coming to say we don't need your forecasting because the currency has been stable. It's not going anywhere. So thank you very much. If you want to forecast anything, we'll come back to you. That tells you that the market and the perception that the currency is going to be stable is now baked in to decision makers. So that is what the companies are saying. But what does it mean for this audience who want to invest? You want to invest in those companies that now know that exchange rates are stable, their profitability is more stable, they are competitive, they are dominant, and therefore the stocks are likely to go up. When we did about a year ago, I think, MTN stock was about 184.
Problem. So I think we've lost Mr. Rewane, bad network. So I guess he will join us very soon. But I'll continue with the Q&A. And there's a question on Dangote Refinery. And Jolomi, I'll ask a question and maybe you can take it. So the person is asking, can Dangote Refinery meet the requirements for listing with the financial listing requirements? Dangote Refinery expansion announcements, well, according to you, is unrealistic based on technical and financial consideration. And this from Alexander. So, Jolomi, if you can just help us with that question.
Thank you very much, Balan. So I think the question is basically speaking about the fact that, or rather the constraint that Dangote Refinery will have in listing regarding having 3 years of financial statements. And there's a caveat in the rule that specifically speaks towards the track record that your core investor has. So if your core investor has a track record of 3 years, there's a caveat that allows you to still list. But even beyond that, Dangote Refinery did start keeping financials even before operations fully started. However, that caveat that I noted at the first instance should allow the refinery to list within the year as is being planned as of now.
Okay, thank you, Jolomi. I believe that is clear. I have another question for you, Jolomi. And this is fixed income. And the person wants to find out that do you foresee a return to stronger dividend payouts from banks in 2026? And what conditions would need to be in place to support this? I think you're muted, Jeremy.
So when we look at banking stocks and we look at banks in general, our views around banks in general for 2026 are painted, or rather do have an element of stronger disbursement for banks, and is tied back to how we see banking evolving in 2026. We just had a recapitalization exercise, which has put a significant amount of liquidity in the hands of banks. And when I look at the capital uplift that I expect from the banking sector, it points towards a significant amount of credit growth in over the medium term rather. We wouldn't expect to see all that credit growth.
Okay, so sorry, I'm back.
Okay.
Oh, I was going again. Yeah. Hello?
No, we can hear you.
Okay, you can hear me. Let's see.
We can hear you. If you can just give a minute.
All right.
Jolomi is running up on his thoughts.
Okay,
Then
no problem.
I'll just call you back to finish up. Jolomi?
Yes. So a significant amount of credit growth, we should see a significant amount of credit growth over the medium term, because one way you can look at it is how much more credit growth or how much leeway the amount of capital the banks will have will give them to improve credit growth significantly. And over the medium term, you will see that credit growth come through. Banks did about 2.7 trillion in the last exercise. If you take that against a minimum capital adequacy ratio of 15% and then for DSIB 16%, it gives you an idea of a significant amount of growth you should see. You can see in risk-weighted assets over the medium term. You can't expect all that growth to come in immediately. So when I take into if I take into context still elevated yields, if I take into context the expectation of higher credit growth and how taking those two together against the current valuations, which to my mind are very compelling, then the banking sector is going to enter a cycle where you can see dividends increase immediately and over the medium term, right? Because what you're going to see is an acceleration in profit growth immediately. Again, taking back to the analysis, if I take singular banks raising 300 billion in capital, that reflects about 1.87, around approximately 2 trillion profit growth. Taking that against the NIMs of the bank, you can see that profits can expand within a band of 100 to 200 billion on just increased capital without looking at banking operations as they have evolved over the medium term. So yes, the valuations, the current environment they find themselves, even as we enter into a cycle where we may see moderate currency depreciation, the banks can increase nominal dividends over the short and medium term. I hope that answers the question.
Yes, I believe so. Thank you, Jolomi, for your thoughts. So we'll just go back to Mr. Rewane. Could just continue what you were speaking to. There are a couple of other questions for you as well, but once you are done with your initial thoughts.
My thoughts on the exchange rate, I told you that it's volatile, it remains that way, and that there's a strong correlation between when the price of oil falls and when the currency devalues. But factor in all imponderables that we do not expect it to fall below a particular threshold. And if you look at the companies that you're buying their stocks to show how exchange rate sensitive they are, you can still get somewhere. And I said at the beginning that the MTN was trading at about 184 naira. Today it's trading at almost 600, whatever. So, and nothing has happened dramatically apart from the fact that they released some results. Therefore, as an investor, I will be very selective. 1, sector; 2, companies within that sector; and 3, the exchange rate and interest rate sensitivity. And then again, if those players are doing well, and I give you an example, there was a company that had its CFO revoked in one state. I won't mention the name. That company is doing very well in the stock market. Within 24 hours, the governor of that state fired the person who revoked the CFO, called the company into the cabinet and all of that, and apologized. And that stock has recovered its value and all. So even with political influences and all of that, a stock that is doing well, a company that is doing well, will continue to perform well, will continue to outperform the market, and we'll see those stocks continue to do very well. So that was my answer to the question. 1, the currency valuation is not pessimistic, it's more realistic. And if it appreciates, good luck. And it only means that you have more upside. But our analysis is based on downside, that oil prices drop and that revenues also fall and the deficit will grow. And we also factored in the whole idea of political uncertainty as well. Thank you.
Thank you, Mr. Rewane. Absolutely brilliant. So there's a question from Claudia Teslim around the external reserve, and he would like you to. He said he used to believe the fund in the external reserve were from the government, and it can be used as a backup for federal government to borrow. So can you just speak to that, sir, very quickly?
Okay. Let me make something very clear. There's this misunderstanding, even amongst leading economists in this country, that external reserves are savings account of the government. They are not by any stretch of imagination. It is just it's the dollar value, or it's a total savings of all participants in the economy, individuals, companies, government. And so the central bank of Nigeria is the bank of the government, the bank of the banks, right? So government money is there, banks' money are there, different people's monies are there. And if they want money, if Garage wants some money, she wants it, she just go to the central bank. Let us go back to what was written on a pound note or a currency note before. That the Central Bank of Nigeria promises to give you the value of this in gold. That was what was in it. So the currency is a promissory note, which the central bank holding your money, right, for you. And you used to have the picture of the Queen. The Queen, the Bank of England promises to give you this amount in gold. So first of all, there was gold standard. We had this amount in gold and this amount in currency. Then we had fiduciary issue. We printed some more money than the gold we had. Then we had dollar issue, which we have these reserves and we print this amount of currency in local. Then we go all the way down. The reality is that the reserves are just assets that belong to everybody. And it's a savings account. So the way to look at it is if you take the total reserves and do a computation of it, you add your reserves to your exports and divide it by your total money supply, you'll get the value of the currency, which is almost the same that you have today. So that's the way to look at it. And the reserves and savings account, if your father has 1 billion naira in savings and gets a salary of 100 million naira a year, and he gets fired, and then we start spending 100 million naira of the savings every year. In 10 years, there'll be no savings, right? And both the children and everybody will starve to death. So you cannot depend. Savings are a fallback. And I want to remind all the people on this call that in economics, we have 3 motives for holding money. Where money is a store of value, but they say we have it for precautionary motive, speculative motive, and transaction motive. Precautionary is very important. Speculative is what we're talking about investing, and transaction is what it is. So the money that we have there, central bank reserves, which is money, is kept for precautionary motive just in case something happens, but also for transaction motive, so people are importing and paying for imports, that goes there. And speculation, we have some money we invest in various instruments, and that's what it is. But the definition of money, there's what we call narrow money, broad money, a wider definition of money, has changed over time. And so normally money supply increases, then like during the time of Friedman, the prices increase automatically. But what is your definition of money? And what does an increase in money mean? So at that time, there was just money was gold and paper money. Then it became gold, paper money, and dollars. Then it became pseudo money, which is Bitcoin and others. So anytime we increase money, we had quantitative easing. We did not see an increase in inflation. What did we see? We saw an asset bubble in. So inflation now, rather than being a consumer price inflation, we now started seeing asset bubble inflation. And that is the next phenomenon that we have to deal with. So don't be carried away that you may be in an asset bubble, that is globally, than being in a narrow definition of money. So definition of money has changed. The rate of inflation is being computed differently. And then asset bubbles are being confused with growth. So you have that. So generally speaking, we're not going to solve that problem in one day. These are definitional and conceptual problems, but basically we believe that we have a situation where in 2026, the imponderables are more than the known unknowns, right? Right, because you have known unknowns and unknown unknowns, right? The unknown unknowns are what we call it imponderables. And in quadratic equations, you have the simple equation, you have simultaneous equation, and then you have quadratic equations where the number of unknowns increase, and therefore the answer is not a specific answer anymore. You have answer based on differentiation of functions. Thank you.
Well, great. Thank you, Mr. Rewane. I'll say economics 101. Yeah, I like the way you sort of demystify things that seem esoteric and make it very simple and easy for the layman on the street. Thank you for that. Course of time, so we'll just take two more questions, and Jolomi will take one, and Mr. Rewane will take the final question. So we have this from Camco, and the question is: Nigerian FGM bonds, Euro bonds are trading at huge premiums. Does it make sense buying those bonds? So, Jolomi, if you can just help with that question.
Thank you very much for the question. So, the way I like to look at fixed income investments is on a relative basis. At that point in time, where interest rates are, is that investment attractive? We've had a period over the last couple of years where we had interest rates on these assets be very, very high. And as such, the instruments were trading at a discount to where they are now. So generally, the expectations are around monetary policy becoming more accommodative through the years, or rather, the interest rates actually becoming more accommodative in 2025, and the expectations thereafter that we were going to see a trend also continue was the reason why you saw the yields on assets trend downwards quite significantly. And that has filtered into the market somewhat this year as well. So when I look at instruments, it has to be on a relative basis. Today, is that the most attractive instrument that you can purchase? Right? If it is the most attractive instrument that you can purchase, then you have to look at it relative to your own needs, right? So if it cannot meet your needs, then obviously there's a mismatch there. However, looking at it on a relative basis in the market that you trade, is that instrument generating enough returns relative to your other investment outlets? So the way I look at that's the prism I would like you to look at investments in the fixed income and euro bonds at this point in time. Now, if it's for trading, you have to look at it from the perspective of how you expect interest rates to transition based on the fundamentals that typically affect interest rates. We've spoken here about the expectation that monetary policy administration will not be as accommodative as previously expected in 2025, forecasting only about 100 basis points reduction in the NPR, which would mean that you may not see interest rate trend downwards too significantly, in which case supply dynamics may affect yields more during the year. You see periods where yields may be relatively higher than where we are today, which means that trading will be quite choppy, and you would have to be very selective and make sure you sequence your investments in the right way. So overall, it's your need or your expectation regarding what you're using, what you're expecting to get from the fixed income. Are you investing for yourself, or are you taking trading opportunities? When you're investing for yourself, you look at it relative to your needs and the other investment outlets that you have. Fixed income returns are capped, but equities returns are not capped. If you're willing to take that risk, you may want to take more equities investment than otherwise. On the other hand, this is one of the first times in a long time where we have positive real return on assets, given that disinflation has taken hold. So from a personal perspective, you have to look at it from the prism I just defined. And then for trading, you have to be more careful, because the significant supply profile during this year means that we will have a significant amount of volatility as the government intensifies borrowings, like we saw in January, where we saw yields rise significantly in the first month. So then you want to more properly align your investments in that case. So I hope that answers the question. Thank you both.
Thank you, Jolomi. And for the final question for today, I'll go to Mr. Rewane.
Yes.
And the person is an initial MAI, so I'm not sure of the name. So the person is asking, what's the basis and effect of property sales on the market, as there's still a significant supply deficit, especially in the lower and medium sectors?
Okay, for housing, the property market is a very interesting market, real estate, because you have real estate, commercial real estate, you have residential real estate, you have office blocks and all of that. But generally speaking, real estate is another hedge for Nigerians, in particular hedge. You have a hedge against inflation. People don't buy gold. Well, you have the main economy, you have the formal economy, you have the shadow economy, and you have the money laundering economy. So if over 20 years you've been in a government office and you've made some money and you don't want anybody to know where it is, you put it in property, park it in property. So recently you've seen developers, you've seen all sorts of people doing that. But why do I think property sales, as people go into politics, this is a different political phenomenon we have. We have everybody in the same party. Therefore, the election is not the election in 2027. The election is the election of getting the primaries, right? So in next month, they will have to have primaries in Lagos, everywhere, right? The moment somebody wins, right? If my colleague here, Rukayat, wins the primaries, the Lagos State primaries, all the people that contested with her, the next day will jump into the next party. But for Rukayat to contest the primaries, she has to buy delegates. The only way she can buy delegates is to sell that property she has there and sell that property she has there, right? So selling of properties and bringing property values down, yeah, there's that correlation, the inverse relationship between property values and electoral cycle. So we expect all of them, everybody to be selling properties. And quite frankly, politicians always believe, they're incredible optimists, they always believe they're going to win, even though it's quite clear that they're going to lose, right? So they will sell their properties, property values will come down. And a lot of those property values are also collateral for loans. So we are going to see that interesting development in the months of February and March this year, where property values are going to be coming down. And some of them will even sell their equities as well to be able to do one or two things. So one has to watch the property market. One has to watch what we call mixed development, where you have office blocks, offices and residential in the same place. We're going to watch those property values on the areas where there's infrastructure, where the roads are good, the drains are good, and all of that. And we're also going to be watching property values in outside of Lagos, where kidnapping and ransom have become an issue. So people want to live in gated estates and all of that. So it'll be interesting. Again, the people on this call are all investors, and they want to know where to put their money. You can invest in real estate investment trusts. You can invest in so many other instruments, but we expect real estate to suffer some volatility, and after the elections begin to pick up again. That definitely will happen.
Thank you, sir. That was brilliant, brilliant. Well, I'll say it's been almost 2 hours of good time. We've learned a lot, and I want to especially thank Mr. Rewane and Jolomi Odonghanro as well for their time, for their expertise, and for providing insights. 2026 obviously is going to be an interesting year, but from my own point of view, I remember when we were coming to 2025, it was sort of a bit bleak. A lot of people were wondering what was going to happen in Naira. Some people think it was going to go to 2,500, some people 3,000. But this year sort of seems a lot calmer than what we were in 2024 and projecting towards 2025. And from what has been said today, there's myriad of opportunities for every one of us. I believe opportunities to make money, opportunities to maximize our investment returns. And so the conversation does not stop today, it only continues. And like I mentioned earlier on, this has been brought to you by Cordros Capital, the entire Cordros group. I believe it's been worthwhile. There are some questions that were not answered. Please, if you want to reach out to us, the contact details is being shown on the screen, which is research@cordros.com. You can also scan the QR code, and you probably see other contacts that can reach us. So please, let the conversation continue. Don't stop investing in opportunities. Every time there are headwinds, there are always tailwinds as well. And every time there are pains, there are gains as well. So thank you everybody for your time. It's been time well spent. Thank you again, Mr. Rewane. Thank you, Jolomi. Till meet again next time. Bye everybody.
Thank you. Bye-bye.
Bye.
Have a good day.